What are Bitcoin options contracts and how do Bitcoin options work? Bitcoin options are a form of financial derivative that gives you the right but not the obligation to buy or sell Bitcoin at a specific price, known as the strike price, at a certain date of expiry. You pay a premium upfront, usually cheaper than buying cryptocurrency outright, in order to buy an option. This is a contract that allows speculators to use leverage to bet on the price of Bitcoin, whether it will go up or go down through calls or puts. So the following keywords you must know: calls, puts, spot price, strike price, premium, and a seller. A call is giving the owner the right but not the obligation to buy a specified amount of Bitcoin at a specified price within a specified time. A put is the same but allows the owner to sell a specific amount of Bitcoin at a specified price within a specified time. Spot price is the current Bitcoin price. The strike price is the price at which the asset can be bought or sold at by the holder in the future. The premium is the difference between the spot and the strike price that the buyer pays upfront, and the seller or the writer is selling their right to decide to the buyer. If the options contract is exercised by the holder, seller would have to abide by the contract. For taking on the risk of doing so, they would have to receive a premium. I know that this might sound all complicated, but trust me, this is very easy. So let's continue by explaining how they work with examples. Jerry buys a call option expiring in 3 months at the current price of $50,000 a Bitcoin and strike price of $55,000. Bitcoin reaches in the next 3 months $60,000, so Jerry makes $5,000 profit. Hooray! Now, if in 3 months the market tanked instead and went below the strike price, then that option is out of the money, it's a keyword also, and expires worthless, making Jerry lose $5,000 or the premium. Now generally the premium is 5 to 10%, and depending on the options contract you can buy more than one options contract, but more on that later. So the options contract premium is 5 to 10% and affected by different factors like volatility and timing, which have a direct correlation to premium, by the way. So if volatility increases of an options contract, the premium increases, and so on. If Jerry buys a puts option at the price of $50,000 and the strike price is $45,000, the market tanked to $40,000. He made $5,000, so it's the opposite of a call option. Generally, traders buy multiple contracts at a time, since the upside in terms of profit is not worth the risk per one contract if you buy one. So also, Bitcoin options that are bought can be in of the money or out of the money, which affects the premium. So for example, an in and of the money call option with the current price higher than the strike price has a higher premium before expiration, while an out of the money call option with the current price lower than the strike price will have a lower premium. Now, what are the benefits to options trading? Some might ask. Larger profit margins with small amounts of money invested, since you only pay the premium on a contract, hence it allows you to leverage huge sums of capital without losing too much money requisite to the leverage. No extra fees. With other financial derivative instruments, there are certain fees that you have to pay over time. With options, this does not exist. But say in futures, perpetual derivatives, let me know if you want a video on that, by the way, you'll pay a funding rate over time to keep your contract going, among other fees, when you cancel the contract or try to sell or buy. And finally, a great way to leverage the idea of taking huge sums of money, right, in debt at the cost of small premium only, with a chance in theory of infinite gains, since if the price goes above your strike price during a bull market, for example, on a call option, it allows some to engage in such practices since the risk is very minimal, so it's very attractive. But what is the difference between a futures contracts and options? Firstly, futures contracts gives an obligation on delivery of the asset, meaning it's way riskier since you're dealing with a bigger amount than a premium paid in an option. Secondly, the potential of losses and profits are theoretically limitless. You could go into debt with this. So future contracts causes you to go into debt to deliver the specific amount of Bitcoin required if the trade didn't go your way. But with current derivatives, on cryptocurrency exchanges. They have a certain liquidation price, so to protect investors from going into debt if their trade didn't go their way. And lastly, Bitcoin futures contract could be practiced without the presence of an expiration date, otherwise known as perpetual contracts. While most options go by monthly to annually to quarterly targets, so you'll never find an options without an expiration date. It just does not work that way. So, in conclusion, the reason I will not discuss strategies when it comes to options trading is because I do not personally believe in financial derivatives and their huge use of risk and luck to some extent. The problem is that even those strategies caused countless stock and crypto traders to get destroyed and lose thousands of dollars in different forms. Since we know that markets are unpredictable, hence short squeezes and huge unexpected news keep destroying traders on a monthly basis. So I highly suggest from an educational perspective and standpoint to do more research on your risk management skills and whether or not you can stomach this unpredictable nature of these financial tools. And the idea of luck is that even if I discuss those strategies, these are not proven 100% and they don't work all the time. Some people would enter an options trade, their options expire worthless, for example, they are out of the money. They did not make any money with one options contract, then they re-enter the market to actually have a rebound and make back the money. So I highly suggest to do your research. I also hope you the best of luck in your investing and see you guys on the next video.